Welcome to Lecture 21 on Risk Management and Insurance. We applied ruin theory to insurance pricing, and now we will use financial models. Let's begin with some definitions. The loss ratio is the insurance claims relative to the premium income earned by the insurance company. The insurance claims are the payments that the insurance company must make to the insurance buyers when those insurance buyers suffer some losses, as for example, a house fire or a car accident and so on. Also, let's assume that the planning horizon is 1 year. Then the expense ratio, that's the underwriting expenses relative to the premium income. The underwriting expenses include all expenses that the insurance company has when it supplies insurance. So, for example, it may include the expenses of writing an insurance contract, but it also will include the marketing expenses and other administration costs. Now, when you add up the two ratios, then you get the combined ratio. So the combined ratio considers both the insurance claims and the underwriting expenses. We will use this notation here for the combined ratio. So we have changed the notation somewhat. In the preceding chapter, Ln was just the insurance claims. Now, Ln includes the insurance claims plus the underwriting expenses. Earlier, we neglected the underwriting expenses. And pi is now the total premium income, including the safety loading. Formerly, we used here pi lambda, but now we drop the subscript. Now here we have the definition of the underwriting rate of return. It's a ratio of the underwriting profit relative to the total premium income. The underwriting profit is just the total premium income, including the safety loading, minus the expenses for the insurance claims and the expenses for underwriting. So we have the underwriting profit divided by the total premium income, and this gives a percentage. So that's maybe something like 5%. So you get 0.05. You can also write it down in this form, just rearrange the equation, and then we have here the combined ratio. So a combined ratio below 1 indicates an underwriting profit. Let's make an example here. So if this combined ratio here, let's say, is 0.95, this means that the expenses for writing insurance contracts are less than the insurance premium. So we get maybe here something like 0.95. So we have here now an underwriting profit of 5%. And if the combined ratio is above 1, that's also possible, then we would have an underwriting loss. Now in this section, we use a capital asset pricing model and the Black-Scholes pricing option pricing model to determine So optimal underwriting return, mu, and premium income. So we will use the two models to explain this underwriting return here and also the premium income. I have here some data from Zurich Insurance. Zurich Insurance is a large insurance company. It's headquartered in Switzerland. It's a Swiss company, but it also was active in South Africa. Down here, let's begin with the ratios. The loss ratio of Zurich Insurance is 71%. So that's a ratio of payments for insurance claims relative to the premium income. And then you have here the expense ratio. That's 31%. Now, when I saw this the first time, I was quite surprised. So the expenses of the insurance company, the administrative expenses, are quite high. They are about half of what the insurance company pays to the insurance buyers when the insurance buyers suffer some losses. So here we have the expenses for setting up insurance contracts, expenses for marketing, and so on. So we should not neglect those expenses. And then we have the combined ratio, which is simply the sum of the loss ratio and the expense ratio. It's above 100%. At least in 2015, the year earlier, it was below 100%. So with this information that is given in the table, we can calculate the underwriting rate of return. Up here in the numerator, that's underwriting profit. It's actually a loss of about $1 billion. If we take the figures of 2015. That's here. They call it the net underwriting result. We call it the underwriting profit. And it's a negative figure. It's put it here in bracket. That's just something done in accounting. Instead of a minus sign in accounting, they quite often use brackets. So we have here a negative, we have here a loss from the underwriting business. Now the premium income, the total premium income, including the safety loading, is $28 billion. That goes here into the denominator. And so you get here now an underwriting rate of return of minus 3.6%. And you also can derive the combined ratio. Just rearrange this formula here, solve it for ln divided by pi. So ln divided by pi is 1 minus mu u. That's straightforward. And you have here minus minus. So you will get here now a combined ratio of 1.036. So it's above 1. And that's what they have down here, 103.6%. So Zurich Insurance in 2015 was making a loss on the insurance business. That happens quite often. So we have a negative return on the underwriting business. So don't be alarmed if your insurance company does a negative return of the underwriting business. We will explain later on that this is actually sometimes, it happens quite often. You see, the insurance company does not just have the underwriting business, it also invests capital. And so it has all those assets, and so it makes return on those assets. And then it has both businesses. Investing, it holds a large amount of assets, so it gets a return on those assets. and then it's not such a problem, okay, if they have a negative return on the underwriting business. Now, equation 25 gives us the profit attributable to the owners or shareholders of an insurance company. So the profit of the insurance company, which then really belongs to the shareholders, that's the underwriting profit that we just had before. Total premium income minus expenses for underwriting and the expenses for the payments to the insurance buyers. And then we have the investment profit that I just mentioned before. So the available funds of the insurance company are the shareholders' capital. And then here we have something that's related to the premium income. And we use this funds generating factor. I will explain it on the next slide. So we have those available funds here. And then those available funds, mostly the shareholder capital, but then also something related to the premium income during the year. And we apply here the interest return that you have, the rate of return on those investments. Maybe the insurance company does a good job and it has here a rate of return of 10%. So you add the underwriting profit, you add with the investment profit, and you get the total profit of the insurance company, which then really belongs to the shareholders. We use here the symbol G for this profit. That's because the book actually the first edition of the book was written in German. And G means Gewinn in German. So that's a gain, Gewinn. That's why I use a G here for the profit. And the K for the capital, okay, in German, okay, capital is written with a K, Kapital. Okay, so the profit attributable to the owners of an insurance company, what the shareholders get, is the underwriting profit, and then the investment profit on the invested capital, which is provided by the shareholders partly, and then also comes from the premium income that the insurance company earns per year. We apply here's a return on it. Maybe the insurance company, as I said, does a good job. So return is 10%. And then we get here now the profit measured in dollars. Now let's assume that the premiums, the insurance premiums, must be paid at the beginning of the year. Then the funds generating factor equals 1/2 if losses occur uniformly during the year. So here at the beginning of the year, the insurance buyers pay the premium income. And then let's assume the payments of the insurance company to the insurance buyers for their losses when they have an accident or the house burns down. Let's those payments, let's assume they are uniformly during the year. So the insurance company gets money from the insurance buyers at the beginning of the year and then uses up this money for the claims of the insurance buyers. And let's assume those claims arise uniformly. That's naturally not completely correct. So will be here some fluctuation. So in the beginning of the year, the insurance company has a lot of funds from those premium incomes. And then towards the end of the year, the insurance company no longer has a lot of funds. So the average amount of capital from premium income is just half of it. So here at the beginning of the year, the insurance company has that premium income and then slowly uses it up. So he has it a lot of funds. Towards the end of the year, it hasn't used up most of the funds from the premium income. So the average amount of capital from the premium income is just 1/2 of it. That's the average amount of capital from the premium income if the insurance claims occur uniformly during the year. If you have this nice straight line here. So the funds generating factor here is 1/2. K is 1/2. You multiply with K. So that's what I do here. You multiply the premium income with K. So we have funds from the shareholders. We have funds that the insurance buyers have provided. We take here the average amount over the year, and that's can be invested and gives us a return, and that also gives profit. Creates profits for the insurance company. Now, in fact, so K is usually bigger than 1/2 because many insurance claims are paid only after a time-consuming process of control and assessment. There is also abuse here. You see, the insurance company would like to pay you late. And there were a lot of complaints when this flood was in Queensland. People had to wait for the insurance funds quite a long time because the insurance company would like to keep the cash and keep it invested. So there is if the insurance company is bad, then sometimes you have abuse here. Now we can now express this in percent. So let's divide the profit attributable to the shareholders. Let's divide it by the shareholders' capital. So again, you get a percentage. So that's a return on equity capital. That's a return on the shareholder capital. Or simply the return on equity. So I divide it here in equation 25. I divide everything by K. So I'm getting here a 1. So and here you have pi divided by K. And then here you also divide by K. Actually, I'm doing here, so I'm getting here the 1. I have the pi divided by K. Here I also have divided by K. And then I do immediately here also a second step. I multiply pi on top and below. Naturally, we can do that, it drops out if nothing changes here. So that's the second step that I'm immediately doing here. So what you get here, this is again the underwriting return. So I can use here the symbol mu. Remember, the underwriting return was defined like this. Underwriting profit divided by premium income. So underwriting profit divided by premium income gives me the underwriting return. And then we have here an interesting, so first thing we see here that the return on equity capital is a linear combination on the return on the investments of the insurance company, mu p, and the return on underwriting. And those returns are multiplied by those weights. So the return on equity capital is a linear combination of the returns on investments and underwriting, where those weights here depend on the so-called leverage ratio. Mu divided by K is called the leverage ratio. So two things here. First, the return on equity is a linear combination on the return on the assets of the insurance company and the underwriting return. And the weights, they depend on the so-called leverage ratio. Now, why do we call it a leverage ratio? You see, an insurance company whose premium income is large relative to the capital stock is highly leveraged. So in that case, the capital stock is low relative to the premium income. Or the premium, you can say the premium income is large relative to the capital stock, meaning the capital stock is low relative to the premium income. So the insurance company does not have a big buffer stock. Remember, the shareholder capital, that was the buffer stock against ruin. So here, the buffer stock is now relatively small relative to the premium income. The insurance company just lives mostly on the premium income during the year and doesn't have a big buffer stock in the form of equity capital. So the insurance company is highly leveraged and it's quite risky. So if it suddenly has unexpected losses, so it has to cover unexpected losses of insurance buyers, then the insurance company may run out of funds. But there is an advantage to having a high leverage ratio. When the leverage ratio is high, then the return to the shareholder capital, the return on equity, is also high. So there is a positive relationship here. A high leverage ratio means a higher return on equity. And so then the shareholders will be happy. But it also means that the capital is low relative to the insurance premium. And so the buffer stock of the insurance company is quite low, and so it's risky. That's a more general principle in finance. Investors like leverage. It drives up the returns, but at the same time, it also increases the risk. Now, leverage is something very important in finance. And so I would like to make you now a second example here that has nothing to do with an insurance company. Let's think about buying a house. So the house price is $500,000 or maybe rand, and let's have no mortgage. So the buyer of the house just pays the full amount of the house price. So the buyer's equity in the house is $500,000. Now, if the buyer is lucky and maybe 1 or 2 years later the house price is higher, maybe $600,000, then the equity of the owner of the house is now $600,000. So the initial investment of $500,000 has increased to $600,000, and the owner of the house has now a capital gain of 20%. But the market may also turn against the investor. And let's assume the house price falls to $400,000. Now the equity of the investor is only $400,000. And there is a capital loss here of 20% because the initial investment was $500,000. That's happening without the mortgage. But let's now do it with a mortgage. So again, the house price is $500,000, and so let's assume the house buyer goes to the bank and gets a mortgage of $400,000. So the house buyer only provides $100,000 of his or her own money, and the rest is coming from the bank. So the equity of the house buyer is only $100,000. Again, if the house price increases later on, now the equity will rise to $200,000. So house price is now, equity is now $200,000 because the price is assumed to be $600 later on, and the mortgage is still $400. So the value of the investment of the house buyer has increased from 100,000 to 200,000. The equity has increased. It has doubled. So there's here a capital gain of 100%, which is much better than the 20%. So it's the same increase in house price from 500 to 600 creates here a much higher capital gain measured in percent. That's because most of the money is coming from the bank, and the house buyer only has invested 100,000, and that investment has now a value of 200,000 when maybe a year or two later the house price is higher. So that's why people like to borrow money in the financial markets. They like this leverage. That's called the leverage. You see, you get leverage through borrowing, through the mortgage. So your capital profit is now 100%, not just 20%, for the same increase in the house price. But it's risky. It can get turned against you. If the house price falls later on to 400,000, then the house buyer still has a mortgage of 400,000, which means the equity has fallen to zero. Basically, the house is now owned by the bank, and the house buyer no longer has any, the investment of the house buyer has been wiped out. So it's a complete loss. Okay, a capital loss of 100%. And it could go in worse. If the house price falls further, then the equity will become negative. And the house buyer may be ruined. So in financial markets, even wealthy people borrow because they like the leverage. They don't need the money, but they would like to have the leverage. So they borrow money. So even very wealthy people, billionaires, they borrow money because then the capital gains are much higher when the market increases. But then if you have a financial crisis and the prices fall, asset prices fall, then even the very wealthy people may actually be in trouble. So that's another example for leverage that has really nothing to do with insurance. So we have seen it here in insurance. With insurance, we speak about the leverage ratio. If an insurance company works with a small amount of capital relative to the premium income, okay, is small relative to premium income, then it's highly leveraged. It doesn't have a big buffer stock. It's a form of shareholder capital. So it's risky. It may run out of funds if it experiences, if there are a lot of losses, if it has to cover a lot of losses to insurance buyers. But it drives up the return on equity. A high leverage ratio here gives a higher return on equity. That's what naturally then the shareholders like. But also the risk is higher. Okay, very important term in finance, leverage. That was the lecture of today. Thank you.